All right, good afternoon. Welcome back here to Trade and Renting. Great to have you aboard. I guess it's morning for most of us, but hey, if you've been up watching the European market, it probably feels like afternoon. Anyway, I wanted to hop on, go out and take a look at the RSI and the Stochastics and how to use those or the concepts of those to build a trade entry system. And last week we talked about J. Wells Wilder, who in 1978 wrote a book that explained the different indicators that he developed. And I do believe that if you're going to get into technical analysis and you're going to be using indicators and charts to build your own or to even trade on a technical basis where you're trading based off of price action, understanding his indicators is key. Now, why would I say that? Well, because in his indicators, he tells different stories. And so let's go out and take a look here, and let's just take I don't know, we could take any stock here. Let's go with let's pull something a little bit newer, a little fresher here. Let's go with Intel. Right? Let's go with Intel. And basically what he does is says, hey, I'm going to look for a few stories. And the stories we're going to focus on here today are the RSI and the slow stochastics, okay? And let's just start with the fast stochastics here. That way we can kind of show the evolution there. But these are very simple, straightforward indicators. A lot of people, when they start dealing with indicators, they get a little overwhelmed with some of the math and everything else with them. But their concepts are very simple. And I know we talked about whys in my last video, but understanding the whys of technical indicators is extremely important. Because if you don't understand the whys behind technical indicators, how do you know what the current reading really means for your stock and how to apply it? And when it comes to the stochastics and the RSI, the whys that they are telling are a little bit different. And the whys that they are telling are things that many of the more modern indicators are telling anyways. And so do you need a more modern indicator, another fancy indicator? Not necessarily. Because out there are a million different indicators, different variations on indicators, but basically it could just be the exact same thing. How often do you see a trader's screen and they come in and they add about 18 different indicators to it and half of them look the same? Well, it's no coincidence. They are the same. They're telling the same story. So does it really give you anything different? And the answer is no. But when it comes to Wilder's indicators, we're going to get a little bit of a difference in things. And when I go and I want to make some sort of entry system and even developing the challenge algorithm, these are some of the key concepts that I looked at and said, okay, can I incorporate these? Now, I have no indicator of Wells Wilder in its original form in the algorithm. None of the math, nothing. But I have the same stories via a different mathematical model, or the same story in the case of the stochastics, just with different parameters, right? And so let's go out and take a look at these. And we're going to talk more about the visual story that we can see, a lot of technical analysis, and even something like the challenge algorithm. It's a mathematical story that you really can't chart and see the way that you can with some of these simpler indicators that basically take the mathematics and show a visual display. And then traders like us, we can pull them up and we can take a look at the visual, and really kind of helps to break it all down. All right. So let's start with the stochastics. This to me is one of the most fascinating indicators to me, and one of the most important indicators in understanding what's going on, but maybe one of the more useless indicators when it comes to trading. Wilder himself said that if you were to give him the stochastics and the price of a stock, he would not be able to trade effectively. He understood that an indicator by itself doesn't give you enough of the story. He understood you have to put different stories together in order to get something that you can really use. But the stochastics is a great building block. It's a fantastic building block, and all it is, right? All it is, it's so simple. Is it just shows you whether whether the price of the stock is high or low over the past 14 days. So let's take the RSI off. Let's put the stochastics above. There we go. And let's click annotate. And let's see. Okay. If we look at let's get a vertical line here. If we look at this day right here, okay, for the stock, let's thin out our line a little bit. But we can see that the stock traded at a new high, a new 14-day high. And that percent K, 14 days, that's all it's talking about. So the stock is trading at a new 14-day high, and the stochastics is high. It's at its max level. We come a few days later, and the stock is trading at a new 14-day low. Where's the stochastics? Well, it's at its low. We come here, where the stochastics is at 50, right in the middle. Well, look at the stock. It's right in the middle of its last 14-day range. It's not at the high, it's not at the low, it's just kind of in the middle of that range. And that's all the stochastics is showing. Is the stock price high or low relative to its recent range? So if we come and we look at new highs on a stock, we're going to see the stochastics has spent some time high, right? It doesn't mean the stock is going to stop going up, right? There's this kind of ludicrous notion out there that when the stock's at a new 14-day high, it's overbought. And when people say overbought, they think, oh, the stock has to go down. Or when it's at a 14-day low, it's oversold, and oh, the stock has to go up. But look at this. Here we come with Intel right here. Stock at a new 14-day low. It's oversold, right? No, it's not oversold. Take a look at what happens to the stock afterwards. You know, it continues to tank, and the stochastic stays low. Very common, right? So overbought, oversold doesn't apply at all when it comes to the stochastic. It's just telling you whether the stock price is high or low relative to the last 14 days. That's the black line. Now you'll see a red line in here. The red line in here is a line that is a simple moving average. It's a percent D is what they call it for the stochastics, and it's just a 3-day moving average of the black line. So basically, you can just see that it is smoother, right? There's not as much herky-jerky action in it. It's just a little bit of a smoother line. So that's all it is. And some people will look at it and they'll say, hey, when the black line crosses above the red line, you buy. When the black line crosses below the red line, you sell. Good luck with that one. I've never seen it work, ever. All it is a recipe for massive, massive whipsaws, right? But what's the story that it's telling us? It's telling us whether the price of the stock is high or low relative to the last 14 days. And that's it. That's it. Do we need an indicator for that? I mean, come on. Most of us are smart enough, to look at a chart and to go, oh, this stock price is high or low relative to the last 14 days. It's not exactly rocket science, right? It's just one of those where, are we getting anything that dramatic here? And the answer is no. We're not. We're not getting anything really magical here. But let's keep going. Let's take this and let's go to a fast stochastics, okay? Or excuse me, a slow stochastics. So we'll take the fast and we'll come in and we'll put this slow stochastics on. And let's see if there's any difference. So we have our two indicators, our fast stochastics up top, our slow stochastics down here below. What's the difference? Well, you'll notice the slow stochastics is a little smoother. Not as many peaks and valleys, not as much choppy, herky-jerky type action. Well, what's going on? Well, the slow stochastics, what it's doing is it's taking the percent D from the fast stochastics and making that the percent K. So our black line on the slow stochastics is our red line on the fast stochastics. So slow stochastics is a little smoother, and this is what technical analysts or technical traders do a lot. They get an indicator that's herky-jerky, and they try to find a way to smooth it out, to get rid of some of the whipsaws and all of that. And that's all the slow stochastics is doing, is they're smoothing it out. They're taking the percent D from the fast stochastics and making it the percent K, and then they're doing a 3-day moving average of that and getting a new percent D. So the red line here is significantly more smooth. So is it changing the actual readings here? No, not really. Not really. It's still telling us whether the price of the stock is high or low relative to the past 14 days, but it's just taking some of the extremes out, some of the big chops out, and giving something a little more reliable. Now, some people will use this and they'll say, hey, buy when the black line crosses the red, sell when the black line crosses below the red. Yeah, good luck with that one too. It doesn't work. It's a recipe for whipsaws, and yes, in hindsight, you can find areas where it did work, but overall, it simply doesn't. What also doesn't work here is overbought, oversold, and looking at above 80 as overbought or below 20 as oversold. It just simply doesn't work, right? Intel was oversold right here in middle of July, and it kept going down. Magical, right? But that's the slow stochastics component here. Now, and either of these all that useful? Not really. We talk about some voodoo triggers you can get from the stochastics, but that's about it. And you say, okay, so any point to this? Well, yes, an absolute major point. When you're developing a trigger system, you have to ask yourself, are you wanting to buy something on dips? Are you wanting to sell something on rips? Are you wanting to buy when a stock is consolidating? Are you wanting to buy when a stock is really low? What are you looking for, right? And for me and for the challenge algorithm, what am I looking for? I'm looking for trend. Well, what do I know? I know that most trends don't start off of a new low. It's just not the case. Yeah, we get big bounces. Sure, we get very big bounces. But what's to distinguish this bounce right here? Let me click annotate. What's to distinguish this bounce right here? Whoops. Right? This action. What's to distinguish this from this action? Same thing. Oversold. Very, very difficult to differentiate. But there is something that is a little bit easier to differentiate, and it was published by John Murphy, a very famous technical analyst, and he took the stochastics, and he does this with a lot of indicators, and he changes the parameters. And what he does is he takes and says, hey, give me 39 days. He uses 39, right? Not 40, not 38, but 39, magical number, right? But you get the point. He's expanding it out. Now, I did 39.1. What does 1 do? It gets rid of the percent D. I don't need a percent D here. Because now, what is my indicator telling me? My indicator is telling me that the stock price is low relative to the last 39 days, or high relative to the last 39 days. So we've expanded our time frame here with it. Now, do most upside trends, do they happen with the stochastics below 50 or the stochastics above 50? Well, when you look at the market and you look at most stocks, the major trend action to the upside happens when the stochastics 39.1 is above 50. The major downside action happens when the stochastics 39.1 is below 50. Now, it's not absolute, right? We get big rallies off the bottom while the stochastics 39.1 is below 50, right? That's not unheard of, and it does happen. But if I'm looking for strong upside trend, I'm much more likely to find it in something where the stochastics 39.1 is above 50. Right? You take a look at Intel. Yeah, it had its bounce off the bottom, and we're never going to call the bottom using the 39.1. Calling the bottom just isn't going to happen. But you can see a very nice trend that emerged here with the 39.1. And so what we've done with the challenge algorithm is we've taken this concept that when the stock is trading or when the stock is near its lows or had a really strong pullback, we'll get bounces, but are they going to be strong trends? Not normally. Okay. And they can be sympathy bounces, like right here in February, where it just bounces a little bit and then tanks. So below 50, basically, we don't want to deal with it trading to the upside. Same thing, above 50, we don't want to deal with it trading to the downside. Now, we don't use 50 as a magical number or anything like that. Every stock kind of does its own little thing. So we actually have in the algorithm the stock looking at its own history over the past few years. But it is one where the whole concept, the whole idea, if you're going to trade to the upside, seeing a stochastics 39.1 above 50 is much more likely to be upward trender than something below 50 is to be. So that's kind of how we've taken it. We evolve it here. Again, we're not using it in Wilder's original version, but we are taking a little bit of a John Murphy element to it, and even taking it a step further from that, and comparing the stock to itself over the past few years. And that's how we use it. And just what's the why here? Well, the why isn't very much, right? But the story here is just, hey, is the stock price high or low relative to its recent range? And while we don't want something too high, we don't want something too low either. We're looking for something in kind of that Goldilocks area, and something where, we've had a stock that's rallied, then consolidated, and, has a good chance of now breaking out to that upside. Okay, so that's the stochastics. Great indicator, and it's very simple to kind of put together, to play around with. And you can come in, you can play with the settings however you want with it. We could do 39.3 and give ourselves a trigger system basically, and say, hey, we're gonna buy when the 39.3 stochastics crosses above zero, and we'll sell when it goes below zero. Again, that's not going to help us all that much, not going to give us all that much. Is going to give us a lot of whipsaws. But we can expand to 7. And this is something we did for the challenge algorithm. I said, can we keep it as simple as this and just run an exit system on top of it? The answer was no. We couldn't. Too many whipsaws. We couldn't find something that was good enough on a consistent basis. Just a lot of this type of action right up here from December, January, where you get this, drop down, pop back up. It's just very difficult to, to stay out of constant whipsaw with it. And whipsaws are no fun. Keeping out of whipsaws with technical indicators is very difficult. And doing it with the stochastics, nearly impossible. So, anyway, we understand what it's giving us, why it's giving us that reading, and what that ultimately tells us. So when I look at the stochastics on Intel right now, what do I read? What do I make from this? Well, not a whole lot, right? I know the stock price is low relative to its recent range. hasn't had much of a bounce. Still near the low part of its range. What do we know? When stocks are down here, the chances of dropping further are significantly elevated. Right? They're significantly elevated. Now, when we start to push back above 20, we see the chances of the stock rallying increase significantly. And so that is, how I would look at it. But I'm not going to trade just off of the stochastics. I'm not going to let this indicator dictate what and how I'm going to trade. It's just not going to give me very much here. Okay. All right, so that's the stochastics. Again, overbought, oversold. Get rid of those elements. They don't matter. It's one of the worst ways to apply it, but just apply the story for where it is on the range. Now, one of the most popular overbought, oversold indicators, and one that it is much more valid than the stochastics, is the relative strength indicator, the RSI. And this was developed by Wilder. This is not an indicator we use in any way, shape, or form in the challenge algorithm. It's just not something that we need because some of the other stuff we have gives us a similar story. Okay, but basically here with the RSI, it's looking at the relative strength. So is the stock, does it have more buyers than sellers? And it's an indicator where there are just better versions out there anymore, right? But there's a couple ways to look at this. Above 70 is overbought. Okay, above 70 is overbought. But be careful. Sometimes overbought doesn't mean it has to go down. Oversold doesn't mean it has to go up. Below 30 is oversold. Okay. If you're just insistent on using overbought, oversold, RSI is a much better tool than the stochastics. And above 50 generally means there's more bullish pressure on the stock. Below 50 generally means there's more bearish pressure on the stock. When I was first learning how to trade, somebody told me, hey, Jeff, just use the RSI. Buy when it goes above 50, sell when it goes below 50. And I thought, hey, okay, that makes sense. That's easy. Very simple. Okay, let me do that. I very quickly learned that chops and pops and drops and whipsaws are very common in doing that. Picking any number, whatever number you want to pick, you're going to get whipsawed. There's nothing magical about 50 or 49 or 32 or any of those numbers. Okay, so it's one where, okay, take it for what it's worth. But one of the things that I like to see is I like to see a general improvement in the RSI if I'm going to be looking for an upward trend, or a general deterioration in the RSI if I'm looking for a downward trend. But I do find that more often than not, the RSI just follows the price of the stock that day, right? And that's not exactly what I'm looking for. Now, the RSI is pretty powerful when it comes to something called a failure swing. And when you see my just general chart format come up, it always has the RSI. And my eye just quickly goes to, okay, do we have a failure swing or no? And on this chart, we don't have a single failure swing. All right, so let's go to a different stock. Let's see if we can find any failure swings here. No on Boeing. What about Bank of America? Yeah, small one, but it's, kind of meaningless there. What about Valero? Let's see. Yeah, I mean there's one here. It's pretty ambiguous, but it's a little tougher to see, I should say. So failure swing is what it is. If you're looking for the bearish, looking to play bearish, what you want to see is the stock come into overbought territory, and you let it be. You let it stay in overbought territory. You leave it alone. You say, hey, it's going to do its thing, and you just let it be. And what you're looking for on the RSI is you're looking for this point where the RSI pushes back below 70. Okay, right here with my blue line. And you mark it. You don't trade it, you just mark it. What you're then looking for is for the stock to push back into overbought territory, just like Valero did right here. Okay? And the stock rallied a little bit. The RSI went back above 70. Then what you do is you take a look at when the RSI breaks below your blue line again. Okay, so right here, breaks below this kind of dip that we saw a few weeks prior. You'll notice it's taken a couple weeks to materialize. But this is referred to as a failure swing. Sorry about my crooked lines here, mouse-drawn lines. But this is a failure swing. And when we break the low from these kind of two overbought positions, that is where you get short and you look for a downside trend to emerge. Okay? And so that's a failure swing. Let's see if we can find a little bit of a better version of one here with another stock. Let's see. There haven't been a lot of failure swings of late. It's just the reality of kind of the market we've been in. Yeah, let's take a look at this one here with Apple because it's setting up with one. So here we go. Apple is overbought, right? Overbought condition right here that we can see the RSI above 50 there, or above 70 there. Then the RSI dips below 70. It gives us this kind of mark right here. And now it's pushed back above 70 and overbought. So what do I look for if I really want to short Apple? I'm looking for the RSI to break down below the level that it hit last week. Okay, that low that it hit last week breaks below that. There's my opportunity to get short. Okay. Now, is there a good risk-reward scenario here? Is there a good stop area here? Normally, no. There isn't. You're looking for you're looking for a pretty strong trend reversal. Can you get whipsawed on these suckers? Yeah, you can. Apple did a failure swing reversal right here around earnings, so you do have to be careful of that. But we have a failure swing setting up here, or possibly setting up here when it comes to Apple. Now we do see the opposite happen, where we can get failure swings be bullish, right, to the upside there. And let's take something like General Motors, and you can see the RSI oversold right here. Pops back up, right? Pops back up, then back down to oversold, then pops back up, but doesn't break above our original level. Gets a little oversold again, then pops back up above our original level, right? So right in this area. And when we see that, it tells us, okay, we have now had a bearish failure or a bullish failure swing. The bears might be running out of some momentum to the downside, and probably something where I should be looking to buy dips rather than sell rallies. And that's really how I look at failure swings. Is they don't give me entry points. They tell me whether I should be buying dips or selling rallies. And when we're coming off of a failure swing like this one here for GM in March, I should be buying rallies. Now, I mentioned the RSI is not incorporated into the challenge algorithm, but this concept of failure swings is. And it's done with just the price of the stock and looking at the momentum, basically the rate of change of the stock, and getting a failure swing off of the rate of change rather than the RSI, but incorporates a little bit of the concept here, just not the way that the RSI calculates the data. All right, but understanding the RSI, very important to understanding the story, understanding the overbought, oversold, and when overbought, oversold is starting to change, and that is the big deal here with it. All right. All right, so that's RSI and slow stochastics. Hopefully that helps you out there with it. There's great information even here at Stock Charts. If you come into the articles, you can just search stochastics and RSI. I mentioned John Murphy, who did the work on the 39-day. He does a few posts here a week, and in Stock Charts. Let's see, is his book in here? Let's see. There's a book that he has that is absolutely fantastic. Technical analysis of the financial markets. If you're looking to really kind of get into these indicators a little bit more, this is one of the best books that I could recommend. So, we looked at Wells Wilder's book. Wells Wilder, J. Wells Wilder, not to be confused with the other Wells Wilder, but J. Wells Wilder, his book that he published in 1978. And then if you want to really kind of build on that, this is a fantastic book. There are some things in it that are a little outdated, but overall, it's a great one to really understand the principles that are going on here with these indicators. All right. Now, next week, what we will do, or excuse me, not now, next week, but next chat, what we will do is we will take a look at two other indicators. One of them being the ADX, the average directional index. Okay. This is one that it's a beautiful indicator. Complicated as all get out to try to pick up the first time, but the principles behind the indicator are absolutely beautiful. And basically, the challenge algorithm is a rebuilt ADX. That's basically what the challenge algorithm is. It doesn't use the ADX or piece of the ADX. We basically, tried to kind of rebuild the ADX to be much more modern and to be a little bit tighter in terms of whipsaws. So the ADX, great indicator. And then we'll also take a look at the parabolic SAR, which is Wilder's version of a trailing stop. You see these dots now that are on the chart, right? This is his version of a trailing stop in using price targets, here. And so I'll show you kind of how we've modified that for the challenge, as we do use a similar principle here when it comes to the challenge. So we'll take a look at those on Thursday, and have those kind of four indicators in play. And if you understand these four indicators, you basically can understand any other indicator that's out there. There's only one class of indicator that you'd be missing, and that's a volume indicator. So we can look at some volume indicators as well. But with with these four types of indicators, you basically get all the stories you're going to get out of price action. And now it's up to you, right, how to piece it together and what you're comfortable with, because some ways you piece it together, you have low risk, high reward, low risk, low reward. Other ways you have high risk, high reward. And so getting the right balance for what and how you want to trade is most certainly key. Thanks for hopping on. Have yourselves a fantastic day. We'll talk to you this afternoon. Take care.